Welcome to my channel, guys. I'm the cover call guy. My goal is to create $120,000 per year passive income using only cover call ETFs. Right now, my portfolio yields about $70,000 and about $6,000 a month. I will update that. I think I'm gonna update that every month at the end of the month, because right now it's about 71,000, but we'll see by the end of the month. I'll update it, and I think I'm gonna start doing end of the month buys and what I'm buying, and along with the portfolio update with how much I'm making yearly and monthly. So that's what I think I'm gonna do. Start posting my buys either in a video format or I'm gonna create a post, depending on what you guys vote for, how you guys think the format is. But I do want to do like an update and change this picture every month. At the end of the month, I'm gonna do an update of how much my monthly progress is for yearly and monthly, and what I'm buying and how much I'm buying. So yeah, okay, all right, let's get started. Legal disclaimer: this content is for informational and educational purpose only and is not financial advice. I am not a licensed financial advisor or tax professional. All opinions are my own and may be incorrect. Trading and investing involve risks, including loss of principal. Please always do your own research and consult a licensed professional before making any financial decisions. I am just some random idiot you found online, and I could be completely wrong. And with that out the way, today we are doing a video on VistaShares ETF and their ecosystem, right? The structural analysis, risk assessment, and investor suitability is prepared for income and growth investors. And this is my quote-unquote institutional due diligence. Welcome to my class. All right, welcome to the video, guys. Hope if you guys are new, this channel is about cover call ETFs and financial news and just a little bit of everything that has to do with finance or financial freedom. Income investing, cover call investing. I try to do that all. But all right, let's get started. We're gonna do the entire Vista share fund and all of their ETF holdings. All right, so my executive summary, right? This is just a summary of what I found. Strategic segmentation, the VistaShare ecosystem. VistaShare segment, its product offering is into three distinct verticals to address divergent investor personnels. One is the Target 15, which is the income, aggressive option income strategies such as OMAH, QUSA, ACKY, and DRKY. In my head it sounds better. All right, and then there's the Supercycle thematic. Thematic just means what's trending right now, what's memeing right now, what's hype, what's the big following. Right? It's long-term duration growth plays, POW and AIS. And then the animal spirits, which is the tactical, is leverage momentum trading, which is they have only one, wild. And then my critical findings for income investors, my verdict is that Target 15 series explicitly target high monthly distributions, about 1.25% per month. However, structural reliance on return on capital reaching 100% in funds like DRKY. Don't report my channel, guys. I'm just DRKY. I probably just say it like that. Raises significant concerns regarding payout sustainability and NAV erosion. Right, the Supercycle and animal spirits fund are explicitly unsuitable for pure income strategies because, again, they're long-term growth plays and they're leverage. So we don't want to do leverage momentum trading. It might not work out. All right, the Target 15 mechanics, right? So manufacturer yield strategy. The Target 15 series aim to synthesize a 15% annual yield through a dual component strategy. Core equities, long positions, and quality baskets. Buffett, Ackman, right? So OMA is their quote is OMA is like invest like Buffett, and then ACKY is the one invest like Ackman, right? So it's good or bad. It's your take on it. It depends how you see it. Do you want to invest in the stuff that Warren Buffett is investing, or do you want to invest in things that Bill Ackman is investing in? It's your choice, your preference. There's no good or bad to it. It's bad if you don't. It's good if you want to. I mean, it's all personal preference there. Options overlay, selling call options to generate premiums. The risk warning, I think, is that in bull markets, upside is capped, just like every other cover call ETF for the most part. Not all cover call ETFs are capped. In bear markets, the 15% may be funded by returning your own principal, which can be destructive rock, okay? So it can be permanently eroding your NAV, net asset value, which is basically, just think of it as our stock price, right? It stays down. And this is just a picture of kind of how a cover call works. All right, OMAH, Berkshire Select Income ETF, right? My verdict is that this is a top pick for conservative income. This is probably the most conservative ETF right now. The strategy behind this, right? OMAH solves the Berkshire doesn't pay a dividend paradox. It tracks Berkshire Hathaway, BerkB, and its top holdings while monetizing the volatility via options to target 15% yield. Why do I think it wins? It converts the world's safest equity portfolio into a monthly paycheck. Even if Berk trades flat, OMA generates income, acting as a Buffett annuity. Right? So they modeled it after this guy. Right? You may not know who he is, but he plays a large part in your life every single day, especially if you have car insurance. Right? OMA detailed breakdown. 10 reasons to invest. Right? The Buffett annuity, right? It's the image of invest like Buffett, Warren Buffett. Create monthly income from Berk without selling. It's a fortress balance sheet. Underlying assets is arguably the safest in the market. Sideways alpha yields 15% even if Berk trades flat. Lower beta acts defensively during market crashes. Tax efficiency about 34% return on capital as of right now. This video that's uploaded November 20, 2025. Right, so it's tax deferred until you sell. No manager risk, right? Betting on Buffett, not a VistaShare picker. Is very, very liquid. I think OMA is about VistaShare is quite new, and OMA has already reached like 650 million. So it's about to be a $1 billion titan. So it's up there. Proven holdings such as Apple, MX, Coca-Cola, all quote unquote forever stocks. It pays monthly, right? And psychological ease, easier to hold through drawdowns. And then I have 10 reasons not to invest, right? Capped re-rating, misses sharp Berk rallies due to call cap. Of course, if you're in there for the income, you're going to miss the growth. High fees at 0.95%. This one, I just put high fee because it is high compared to other traditional cover call ETFs. It's not bad depending on your returns, but I put it as high. So, I had to list something. Some people don't see this as high because of the returns. I get it. That's fine. Right? So, and then, of course, if you're investing in Buffett, it erodes compounding magic. Sector drag. It's a lot in financials and staples, often like tech bull runs. And then the tax bill risk, cost basis reduction lead to future tax bill. Of course, if you sell or whatever you end up doing. Key man risk, uncertainty when Buffett eventually passes, right? He's already stepping down. He will still play a role, but he's no longer the head figure. Right? Underperformance will trail BerkB in strong bull runs. Of course, we're not here for growth, so that's not 10 reasons not to if you want growth. Interest rate risk, banks, insurance, sensitive to yield curve, cash drag, right? You're paying a massive fee. Variable yield, low volatility drives up option premiums, right? That's in a very, very, very down market. And of course, you have no writing rights, right? So you have no say in how they operate. All right. QUSA. Okay, USA Quality Income EFT. My verdict, it's a core income contender on it's solid ETF right now. Solid ETF's not bad for what they offer. Right, VistaShares. The strategy behind this is that I focus on quality sector, high return on equity, low debt, and low earning variable. It combines this defensive core with an aggressive income overlay. Why does it work? Why do I think it works? With lower return on capital, around 20% as of year to date right now, as of this video, November 20th, 2025, than its peers, it relies on a more organic quality and dividends. It offers the smoothest equity curve in the lineup, suitable for sleep well at night portfolios, which is what I'm all about. If you're new to the channel, I try to always put sleep well at night cover call ETFs. I do not own any yield max at the moment. My highest yield is BTCI. But for the most part, I like my 8% to 15% range. I like to sleep peacefully at night. And if you do, then this one might be for you, QUSA. All right, QUSA, detailed breakdown of 10 reasons to invest. Sleep well at night, like I said, quality factors, right? Sustainable payout as of right now. Inflation protection, we all want that because right now inflation is killing anybody that's making less than $150,000, I like to say. Lower volatility, right? So low beta stocks plus call overriding equals smooth curve. Income boost, transform transform low yielders like Visa into high yielders. Diversification holds about 120 plus names. Very, very low risk of concentration risk, right? So another reason over OMA, right? Defensive positioning, like you said, is very like I said, um, very diversified, right? In a lot of sectors, works in late cycle economies. Professional management mitigates assignment risk on stable stocks. It pays monthly, and it's so far it's been has been proven to be very tax efficient. 10 reasons not to invest. Again, I'm gonna say it, upside cap, right? If you're here for the growth, just buy the underlying. High fees, like I said, as OMA 0.95, right? Growth flag, options pricing, interest rate sensitivity, complexity. There's a lot of moving parts of these very strict and complex cover call ETFs that you might not know what the fund manager is doing. There is some overlap. I wouldn't be too worried, but I had to put a 10 reasons not to. So there is overlap. If you don't want any overlap at all, then this is not to invest. Tax reporting is going to be a mix, so it's very complicated. Even though it's very tax efficiency, on 10 reasons to invest as of right now, what they're saying and providing and giving out, but we won't know until the end of the year for sure. And then limited tech, so the underweight Mag 7 AI trade versus the Nasdaq. Then the track record is very, very new, so there's limited recession testing. All right, then we go into ACKY, right? Activist distribution. My verdict is that it's a viable satellite holding. This would be a non-core. This would be built up after you built up your core, right? The strategy behind this is that it mirrors Pershing Square, which is Bill Ackman's hedge fund. Right? You have to have high conviction in him. It's concentrated, so it's whatever he holds, like Uber, Chipotle, Hilton. The risk portfolio is at super high concentration with 66%, with also 66% return on capital. The payout depends heavily on capital gains and premiums, not dividends. Right? In the row, a growth income hybrid for those seeking hedge fund light exposure. Right? So if you want to act like you own part of a hedge fund, this is it. ACKY. Detailed breakdown of 10 reasons why I think you should invest. 1, you have high conviction in, Ackman. It has a lower lag risk, right? So Ackman hold for years, making 13F valid. Systematic income, monetized on non-dividend payers. Blue chip quality, right? Profitable Y-moat North American caps. Tax deferred with high return on capital. Activist catalyst. And what I mean by that is that it benefits from strategic management shifts. So if one management style is not working, they swap out. It pays monthly. It's very consumer focused. Professional options and diversification. 10 reasons not to invest in this. Again, very, very extreme concentration. Top 2 holding is often more than 35% of the fund. So if those top 2 holdings start to crack, this is going to start to crack too, and all it takes is those 2 holdings. It could be very destructive rock because of 66%, which could mean it implies into dipping to the principal, so you have to keep an eye on that. It's a key man risk because, again, just like OMA, the strategy relies entirely on Bill Ackman, so it's the image of him. High fees, like 0.95, of course. I'm going to put high fees here. Capped winners, right? So misses 10 baggers upside due to calls. If you believe in just Bill Ackman, go ahead and just buy his fund or whatever stocks he hold. Interest rate sensitivity, like usual, because it's heavy real estate exposure. Crowded trade, and what I mean that is that it could be a very poor exit liquidity if you want to sell, right? If the thesis start to break and the conviction starts to break and everybody starts to sell, you might not be able to. And of course, no insider access, right? No voting rights. This is a cover call ETF. You don't actually own the underlying. If you want voting rights, own the underlying, right? And then consumer the cycle of what's happening right now, right? it's exposed to how the market is, not the market, but how the economy can be, right? So it goes in a circle, and usually 4 point, right? Euphoria, everybody's buying. It cools down, it sells, and then it goes back to normal, and then it buy, and it cool down, it sells, and it goes down like that, right? So like Chipotle, Hilton, and like Hilton, it's seasonal. Summer, everybody goes on vacation. Winter might be dead, spring might pick up. Fall slows down. So yeah, and then tax complexity, again, we don't know if it's going to be 66% rock all the time. And then DRKY, so I don't get canceled. All right, so we're going to talk about this. My verdict is that it is very high and is very speculative. The strategy behind this is that it mirrors Stanley Druckenmiller Miller's, I'm not going to say that, family office, highly invested in biotech, which is a very, very speculative field and macro themes. The critical fault I think I see in this is that it is a high velocity trader tracking 45-day or 13 filings. Creates phantom exposure, right? So those 13 F filings from these hedge funds or these these big players, it's late. It's 45 days late. So by the time you do something, it's gone. It's different, right? And so recent division was 100% rock, indicating payout is funded by returning capital. So we have to be very, very careful when it's near 100%. You have to watch the NAV. All right, so my detailed breakdown of 10 reasons to invest. Legendary pedigree, right? Access to Druckenmiller's macro insights. They are very big. They are very well known. High yield, 15% target and best in class. Uncorrelated assets. Biotech moves independently of GDP. Tax efficiency, as in right now, is 100% rock. Biotech volatility, right? Generate rich premium incomes. Active overlay, professional management, and then differentiation, zero overlap, right? Macro hedge, potential to catch big macro pivots, monthly income, and then of course the speculative upside, right? High risk, high reward. Again, 10 reasons not to invest in this is because 100% destructive rock, right? Paying dividends from principal, all of it can and will or could erode NAV. You have to monitor it every single day, and you have to be careful of it, right? 40-day lag. Looking at those 13F from 45 days ago, things can be very different. Right? So by the time you bought, when they bought, they could have sold 45 days later, and you're holding it. Biotech binary risk could be rejected by the FDA, and then what? Completely destroys your thesis. Missing short books, misses the short side of Druckenmiller genius. Again, high fees, capped upside, liquidity risk, sector concentration. As of right now, there's no organic yield because of its 100% rock, and the underlying stock pays 0% dividends. And right now, I would say it's unproven. This ETF is unproven. So we will have to give it some time. All right, and then the Supercycle, right? The two ETF is POW and AIS. My verdict, growth only, no income. POW, electrification. AIs is the AI, the data centers, the semis, So the electrification is the picks and shovel for the energy grid. Is to build it up, right? While everybody's digging for gold, you sell the shovels. The pros, the AI power demand it's going to be needed. You're not going to be able to further AI if you don't have the power demand. The con is the interest rate, right? So things can go up, things can go down as quick as 1 or 2 months. And then the AI, of course, is pure hardware. The pros is memory Supercycle, which is the company. Direct AI play. The cons is that it's cynical boom bust, right? Highly crowded right now. There's a lot of people trying to get into this field. 10 reasons to invest in the Supercycle, right? Derivative play on AI, industrial moats right now. You're trying to get into the biggest players because they will hold a bigger ground and market share, and they will just dominate. Memory Supercycle, HBM shortage captures. inflation hedge, real asset pricing, global reach, right? Includes Asian hardware giants, right? That's gonna be that's pretty much not the biggest market, the second biggest market. Of course, regulatory tailwinds. They're gonna be good or bad. It's it's different. You know, low overlap, active management, supply chain power, right? Critical bottlenecks. So the prices are gonna stay high. You benefit from that outperformance. 10 reasons not to. Right now, there's for income investors, you know, this no manufacturer yield doesn't pay anything. It's straight growth. Interest rate is very cynical. Geopolitical risk, regulatory lag, concentration, value premiums, energy constraint, commodity costs, and credit trade. So this is a pair growth. And then we talk about wild, the animal spirit, right? The leverage, 2x daily, right? It is a 2x daily leverage risk. My verdict, avoid for income. Strictly a trading tool. You get in and out, in and out, in and out. That's it. Don't look back. Just keep it moving. Right? Daily resets create volatility decay. You lose money in sideways markets. The strategy here is to just leverage the 5 most traded momentum stocks, NVIDIA, MSTR, or via swaps, and rotates monthly. 10 reasons too, though, even though I think you shouldn't, but this is for the traders. Explosive upside, capital efficiency, sediment algo, tactical alpha, crypto AI proxy, no margin needed, good liquidity, monthly rotations, risk on signal, and diversification. 10 reasons not to for the investors, for the income investors like myself and maybe you. Volatility decay, right? No income. The fees is 1.29%, exorbitant fees. What the hell? Hell no. Right? Rebalance drag, tax nightmare, counterparty risk, path dependency. It's I believe is a psychological trap, right? Encourage FOMO because it's 2x leverage, and timing difficulty. You have to enter it where it's actually very, very low on the price. And then we just compare it, right? My top pick right now is going to be OMA, and then right below that is QUSA. But really, honestly, I can have QUSA on top and OMA on the bottom. I just have it strictly for this video's purpose that, you know, I pick OMA. But either way, I think those two were great. Disclosure, if you watched up to this point in this video, I did own OMA. However, I sold it all for Maggie because that's the position I am building up right now. Will I get back into OMA? I would say there's a good chance, right? It's either going to be OMA or QUSA. It's either or. But I will not be touching anything else from VistaShares besides these two at the moment. OMA has been treating me very well. I have no problem with it. I do have to keep an eye on it because it is very volatile right now. I want something a little bit more stable, which reason why QUSA, or both, or I'll end up owning both, which I have no problem with that too. But if I were to pick one right now, I would probably go with OMA. Unless things change, then I'll probably go with QSA. But I feel like they're both very, very similar, if not the same. So it's the top two picks. And then my final recommendation, of course, prioritize structural integrity over headline yield, right? Buy OMA QSA, best balance of asset quality, lower rock, sustainable income mechanism. Avoid DRKY and WILD. My opinion, they have structural flaws, data lag, volatility decay, and outweigh speculative benefits. And that is my end of this video, guys. Thanks for watching. Let me know if you agree, disagree. Let me know if you're gonna buy VistaShares. Let me know if you're gonna buy OMA or already have OMA, or buy QUSA or already have it. Let me know how it's treating you. If you guys are building up that position, you know, subscribe, comment, like. That let me know you guys enjoyed the video. If you guys have any questions, leave it down. You know, love, hate, I appreciate it all. Leave it down. You know, if you want me to do a video on comparison of your portfolio or your stocks, I'd love that. Give me new ideas. I'm trying to make videos based on daily news, and the stocks that I used to hold and holding. So let me know. I love doing deep dive researches. So I don't mind making a shout out to you guys and doing an ETF that you guys hold, for the good and the bad. Thanks for watching, guys. Catch you guys on the next. Stay tuned.